Artificial intelligence stocks, better known as AI, are dominating the headlines and capturing the attention of just every investor. But the real question here is, how do you invest in AI the smart way? AI is not just about one company, it's a vast ecosystem that includes everything from advanced chips to data centers, all powering the future of the technology. With multi-billion-dollar partnerships popping up all around us, the time now is pivotal. This could either be the dawn of a new economic era or the start of a tech bubble. Every major tech inflection point, whether it was the dot-com boom or the rise of the mobile, has brought the both incredible breakthroughs and the sobering failures. Today, we'll be breaking down the entire AI landscape, highlight the companies that matter most, and explore 4 key investing strategies to help you build smarter exposure to this trillion-dollar trend. If you'd like to skip ahead, check out the timestamps in the description. Alright, let's dive in. Investing in AI stocks is like stepping into a new frontier of opportunity. The global AI industry isn't just reshaping tech as a whole, it's redefining entire economies. We are entering an era marked by soaring demands for computing power, energy, and capital. Unlike previous digital revolutions driven by software, today's AI growth relies on both advanced algorithms and the physical construction of infrastructure like concrete, steel, and silicon wafers. Data centers, once the unsung heroes of cloud computing, have now become strategic assets. Their power consumption is expected to double in the coming years, leading to multi-trillion-dollar corporate investments and innovative financing solutions. AI's economic impact is rapidly spreading across consumer, enterprise, and industrial sectors. Adoption rates are growing fast, but revenue is slow to follow. ChatGPT, for example, is gaining users at an impressive rate, yet its revenue growth is not keeping pace. In the enterprise space, companies are diving into AI to boost efficiency and productivity, but many are still struggling to see real profit gains. This means there's plenty of rooms for new players, whether they are disruptive startups or the established tech giant. As you consider investing in AI stocks, it is key to look beyond the surface to truly understand the infrastructure and the market dynamics. That's where the real opportunities lies. And the AI industry is just getting started. Before knowing how to invest in AI, we'll first need to understand where the money flows through its ecosystem. The AI ecosystem is built on 3 key layers: infrastructure, core technology, and applications. Together, these layers fuel innovation and create real-world business value. Let's start at the bottom of the pyramid. With the infrastructure layer, this is the backbone of the AI world, providing the physical and energy needs to keep everything running smoothly. Think of power grids, energy sources, data center setups, and cooling systems. These components deliver reliable power and a stable environment, acting as an unseen backbone of the entire AI supply chain. First, energy supply is crucial. We are talking about generating power from nuclear plants, gas-fired stations, and renewables like wind and solar. Did you know a single AI data center can consume as much electricity as a whole nuclear reactor? Can you believe that? Pairing small modular reactors with green energy is a promising long-term solution for AI's power hunger, and it's attracting significant investor interest. Key players in this space include Constellation Energy, which operates several nuclear plants and is gearing up to power AI hubs with the small modular reactors. Vistra Corporation is another player, blending gas and nuclear to meet the massive power demands of AI. Then there's OKLO, which is pioneering small modular reactor technology and has a pipeline ready to support data centers. Next up is the power grid itself. This is the delivery network that transports electricity from plants to users like AI data centers. With AI data centers expanding, global power needs could jump by 15 to 20% by 2030. Listen up, because upgrading grids with smart technology and integrating renewables is where savvy investors are focusing their efforts. Key players here include Nextra Energy, the largest U.S. renewable energy provider, and Duke Energy, which is modernizing its grid to meet rising demands. Now, let's talk about data centers. These facilities are the heart of AI computing, housing server racks, storage units, and networking hardware. Globally, the data center market is projected to grow by over 10% annually through 2030, driven by AI's insatiable need for computing power. Companies like EQIX and the Digital Realty Trust are fronting the space here, building data centers tailored specifically for AI firms. Finally, cooling systems. AI rigs generate a lot of heat, and effective cooling is essential for efficiency and longevity. Innovative cooling methods could reduce energy consumption significantly, making them a game changer for data centers. And at the forefront of this sector are companies like Vertiv Holdings and Schneider Electric. I wonder if they have their AC on 24/7. In the middle of AI ecosystem pyramid is the core technology layer. This is the driving force behind AI, providing the computational power needed for data processing, model training, and inference. Let's start with the storage and memory. Think of this as AI's memory vault, holding and fetching massive amounts of data. High bandwidth memory, known as HBM for short, speeds up processes, while solid-state drives store training sets and models. Big AI models can consume terabytes of memory and petabytes of storage. To put this into perspective for you, 1 terabyte is 1,000 times larger than 1 gigabyte, and 1 petabyte is a quadrillion bytes. Wow, that's a lot of zeros. The demand for HBM is expected to grow by over 30% annually from 2025 to 2030, which is significant opportunities for investors. Key players here include Micron Technology, a leader in HBM and DRAM, and Western Digital, which focuses on high-capacity enterprise storage solutions. Next, we have networking, the fast lanes in data centers. High-speed switches and cards enable seamless data flow between servers needed for training AI models. The market for networking technology is growing fast, with a projected value of $20 billion by 2025. NVIDIA acquired Mellanox to dominate AI networking, and Arista Networks' cloud and AI switches are well established in the space. These two companies are key players in this space. Now, let's talk about logic and chipsets, essentially the brains of AI. This includes GPU, which stands for Graphics Processing Unit, TPU, also known as the Tensor Processing Units, and even quantum processors that tackle complex calculations. The AI chip market is expected to reach $150 billion by 2025, making it a potential area for investment. NVIDIA continues to lead with its powerful GPU, while AMD is making waves with its MI300 accelerators. Quantum computing is also on the rise, with companies like IONQ and D-Wave Quantum pushing the boundaries of what's possible. Moving on to the data and model segment. This is where raw data is transformed and polished. By 2030, the market for this segment is forecasted to grow from $45 billion in 2025 to over $120 billion. For a start, data acquisition is important since a solid data set underpins model training. Companies like Informatica and IBM are pioneers in data management and integration. They ensure that businesses can make informed decisions based on accurate data. Finally, we have model deployment and distribution, which is all about getting those trained models into the hands of users. This segment is expected to grow by 40% in 2025, driven by cloud technology. Companies like IBM, Amazon, and Microsoft are at the forefront, making it easier for developers to deploy AI solutions efficiently. Onto our final layer, where AI truly comes to life, is the application layer. This layer integrates AI into various sectors, transforming the foundational work of the lower layers into real products and services. The market for AI applications is projected to reach $80 billion by 2025 and soar to $250 billion by 2030, with a compound annual growth rate of 20 to 30%. Let's start with the enterprise applications. This is the backbone of AI in business, with applications that automate routine tasks, enhance efficiency, ultimately reducing costs and sharpening competitive edges. The broad appeal of these tools drives steady demand, with Gartner predicting that enterprise AI will exceed $100 billion by 2030. Key players in this space include Salesforce, which integrates AI into its CRM tools, ServiceNow, which excels in AI-driven IT management, and UiPath, a leader in automation that streamlines business processes. Next, we have consumer applications, which blend AI into our daily lives. With smartphones and smart devices everywhere, the number of users is climbing significantly. Statista estimates that the consumer AI market will hit $50 billion by 2025. These applications enhance user experience and drive consumer spending, making a significant impact on the economy. Major players here include Amazon, with its Alexa voice assistant and personalized shopping recommendation, Alphabet, which uses AI to enhance its search and YouTube algorithms, and Meta, which fine-tunes social media feeds and advertisements to maximize user engagement and revenue. Industry-specific applications are another key area. These custom AI solutions address unique challenges in sectors like healthcare, manufacturing, and logistics, just to name a few. The high barriers to entering these markets is exactly why these apps often lead to substantial profit margins. IDC forecasts that industry-specific AI application will exceed $80 billion by 2027, making them vital for companies looking to differentiate themselves. Key players include Palantir, which tailors its platforms for sectors like retail and finance, CrowdStrike, which uses AI to detect network threats in real time, and Intuitive Surgical, known for its Da Vinci robots that leverage AI for precise patient analysis.
That was a lot. If you're enjoying what you're watching so far, make sure to give this video a like. Now that we have covered AI's ecosystem, let's move on to the companies building the apps we use every day. These can be divided into three main groups. The first group is the foundation model providers, the backbone of today's advanced generative AI applications. These large, general-purpose AI systems enable everything from chatbots and virtual assistants to coding copilots and creative design tools. Some of the most influential providers in this space include OpenAI's ChatGPT, Google's Gemini, and Anthropic with Cloud. As preferences evolve, users are matching each platform's unique strengths to their specific needs. For instance, ChatGPT excels in coding, writing and generating creative assets, making it a reliable system for over 800 million users weekly. Next on the list, with 400 million monthly users, is Gemini, which stands out with its multimodal capabilities, perfect for productivity and summarization tasks, especially for those using Google Workspace. Meanwhile, Cloud focuses on safer outputs as it is ideal for legal applications, attracting around 30 million monthly users, particularly in compliance-driven sectors. Each provider generates revenue through a mix of subscriptions, enterprise API licensing, and strategic partnerships. OpenAI derives about 55 to 60% of its revenue from consumer subscriptions, while Anthropic relies heavily on API usage. Google combines its revenue streams from workspace ads and hardware, showcasing the diverse monetization strategies in this competitive landscape. The second group of companies are the application layer leaders that bring value directly to consumers and businesses alike. Leading players in this space include enterprise software giants like Microsoft with Copilot, Salesforce with Einstein, and ServiceNow with Now Assist, just to name a few. These companies harness advanced AI technologies from generative models to recommendation engines to deliver smarter personalization at scale. But it's not just the big names making waves. Some startups are breaking new ground with entirely AI-powered applications, workflow generators, and industry-specific tools. They target everything from knowledge work to education and design. In this competitive landscape, embedded AI has become a key differentiator in creating new business models. Interestingly enough, the barrier to entry for new players is not as high as you might think. Next-gen challengers can leverage public APIs from companies like OpenAI and Anthropic, or even open-source models that quickly prototype innovative tools. This means that fresh ideas can emerge rapidly, keeping the market dynamic and exciting. When it comes to monetization. At the application layer, revenue streams are closely tied to bundled and premium subscriptions, usage-based fees for API access, data partnerships, advertising, and sometimes marketplace or in-app purchases. As generative AI becomes a core component of mainstream applications, these revenue channels are expected to diversify. For now, however, AI revenue is often blended into the overall product earnings and is growing as adoption accelerates. The third and last group of companies are the service integrators. They play a pivotal role in helping enterprises adapt and scale AI models within their complex systems. While application layer solutions provide ready-to-use tools, most businesses need expert partners to navigate their unique data environments and compliance framework. This is where service integrators come in, offering specialized technology, deployment, and industry expertise. Leading companies in this space include Accenture, IBM, and Capgemini, which focus on custom AI strategies and large-scale integration. They provide end-to-end deployment compliance support and change management. On the cloud side, giants like Microsoft Azure, AWS, and Oracle host and scale generative AI workloads, offering services like cloud hosting and model fine-tuning. Data and analytics platforms such as Databricks and Snowflake help unify data and develop models, while vertical specialists like Palantir and Optum create industry-specific AI systems tailored for regulated domains. For service integration leaders, AI-related revenues often blended with broader digital transformation earnings. Typical 50 to 70% of their AI-specific income comes from large professional and consulting projects, while 30 to 50% is generated from managed services like cloud hosting and ongoing support. Although AI currently accounts for a modest share of total revenue, this segment is growing rapidly. Look, I totally get it. Understanding the entire AI value chain can be quite complex, with various players to watch and technical nuances to understand. Investing in AI adds another layer of difficulty, as you need to grasp both the business operations and the opportunities within the space. Good news, you just got the fundamentals down. If you need a refresher, you can always refer to the timestamps and or watch the video. Just like any industry, having a solid investment framework is key to evaluating potential returns and risks. In order to navigate this landscape, you can consider these 4 investment strategies. When it comes to investing in AI stocks, one effective strategy is to focus on big AI scalers. We can categorize AI players into 2 teams, the incumbents and the contenders. The incumbents are the established giants with a strong foothold in their respective markets, often referred to as the Magnificent Seven, which include NVIDIA, Microsoft, Amazon, Alphabet, and Meta. On the flip side, we have the contenders like OpenAI and Anthropic, which operate large language models, and infrastructure providers such as CoreWeave and Nebius Group, that they rent out GPU-powered data centers for AI workloads. Data platforms like Snowflake and Databricks, along with AI tool providers like Palantir and AppLovin, also fall into this category. Investing in large incumbents offer a more compelling risk-to-reward scenario, since they have established businesses with dominant market shares. For example, Google leads in search and advertising, while Meta excels in social media advertising. These companies enjoy impressive profit margins and positive cash flows from their legacy businesses. While competition in the AI space is fierce, the dominant market share of these big players creates a solid competitive moat. Their substantial cash reserves allow them to invest heavily in AI, hire top talent, and acquire promising startups. Even if there is a slowdown in AI development, these companies are unlikely to face existential threats, as their original business can support them. However, it's worth noting that the contenders can offer explosive short-term returns. For instance, in the past year, Palantir stock has skyrocketed by over 300%, while CoreWeave has seen a nearly 250% increase. So, if you want to be a clever investor, consider the stability of the incumbents while keeping an eye on the potential of the contenders. If you prefer a simpler route, you can explore different sections of the AI value chain through exchange-traded funds or ETFs. The AI value chain is rather extensive, featuring various nodes such as energy providers, data center scalers, chip designers. Well, you get it, the list goes on. But by investing in ETFs that cover these different segments, you can achieve broad diversification and reduce the risk associated with single stock investments. For instance, the iShares Semiconductor ETF, known by its ticker SOXX, tracks the New York Stock Exchange Semiconductor Index. Its top holdings include major semiconductor players like NVDA, AMD, and Intel, which are necessary for AI development. Another option is the Global X Artificial Intelligence Technology ETF, or AIQ, which has a broader focus on tech enablers like cloud computing. This ETF includes giants like Microsoft, Amazon, and Alphabet, all of which dominate the AI cloud service market. An often overlooked segment of the AI value chain is the energy providers. As data centers and computing power grow, electricity consumption is projected to rise from 4 to 12% of total U.S. power consumption. The Defiance AI and Power Infrastructure ETF ticker, AIPO, tracks the niche segment and includes energy companies that can support the future of AI, such as Constellation Energy, VRT Holdings, and OKLO. However, there are some limitations to investing in ETFs. You might encounter overlaps, as many AI ETFs are heavily weighted towards a few mega cap companies. These funds can also be sensitive to broader tech sentiment, and management fees can eat into your returns. So while ETF can be a smart way to invest in AI, it's important to do your homework and understand the fundamentals. Another effective strategy is to look beyond the tech sector and consider non-tech companies that are implementing AI solutions and applications. Technology is not just a standalone industry, it influences every aspect of our daily lives. As AI continues to drive innovation, many other industries can also benefit from the capabilities. Take healthcare, for example. Companies like Pfizer are using AI to accelerate drug discovery. They employ machine learning to analyze vast data sets and predict molecular interactions, which shortens development timelines and boosts research and development productivity. Similarly, Moderna leverages AI in designing mRNA vaccines, showcasing how biotechnology and computational biology can work hand in hand. Even retail giants like Walmart are increasingly using AI for supply chain optimization, demonstrating the impact of AI exceeding far beyond traditional tech companies. The main investment upside here is the potential for growth that AI can bring to traditional sectors. Non-tech companies often have relatively low valuation compared to their tech counterparts, which means they can increase revenues and cut costs as they adopt AI solutions. However, it's important to note that non-tech firms may be slower to adopt AI than their tech-focused peers. And finally, consider looking beyond America and invest in non-U.S. AI players. Over the past few years, the AI narrative has largely centered around the American stock market, and it's easy to see why, since many U.S. firms are leading innovation. However, the current valuations of their stocks have climbed quite high, prompting investors to seek opportunities overseas. For instance, Chinese tech giants like Alibaba and Baidu are following a similar playbook as their American counterparts. They are investing heavily in AI, developing large language models, and operating massive cloud businesses, with some even working on proprietary AI chips. The key difference here is that these Chinese AI companies are trading at much lower valuations compared to their US peers. If we shift our focus to Europe, we'll find players like ASML Holding, which produces lithography machines essential for AI chips, Nebius, an AI infrastructure provider, and SAP, known for its enterprise software. These companies are also making strides in the AI space. However, there are some limitations to this strategy. The investment universe for AI development outside of the US is relatively small, as many of these companies are still in the early stages of their AI journey. If we exclude the notable players from Europe and China, most non-US AI companies have a long way to go. I'm sure we all agree that AI has been the most transformative tech since the internet. Naturally, the opportunities ahead are massive. McKinsey estimates that by 2030, AI could contribute between 3.5 to 4.4 trillion in economic value across all sectors. That's a number that surpasses the GDP of almost all the countries out there. Investors can look at large AI scalers, non-tech adapters, even energy providers that support AI. The real magic happens when established and emerging players collaborate, enhancing computing power and sophistication in AI models. This synergy will not only drive AI forward, but also catalyze trends like quantum computing and the Internet of Things, merging our physical and virtual worlds. When it comes to investing in AI stocks the smart way, it's important to understand the risk involved. One of the most pressing concerns is high valuations. After a significant rally, many AI stocks are trading at lofty prices. For instance, NVIDIA has a forward price-to-earnings ratio of 30, which, while not that high like among AI players, is still relatively steep compared to the average P/E ratio of S&P 500. Then there is a Palantir, boasting a staggering 217 times forward P/E ratio, possibly the highest among S&P 500 constituents. Even OpenAI, which isn't publicly listed, has a valuation of $500 billion despite generating just 14 billion of revenue, giving it a price-to-sales ratio of around 35. These elevated valuations reflect the optimism surrounding AI, but they also leave little room for error. A slowdown in capital expenditures or disappointing earnings could lead to a sharp correction. Another risk to consider is the intense competition within the AI sector. Historically, the tech industry has been fiercely competitive, and AI is no exception. Large language models like OpenAI's ChatGPT, Google's Gemini, Anthropic's Cloud, and others are all vying for market share. Since we are still in the early stages of this competition, the outcome remains highly unpredictable. It will depend on which player can develop the most advanced technology and sustainable business model. We also need to be cautious about circular transactions and financial sustainability. Recently, we have seen complex financial maneuvers among chip makers and AI companies involving buying and selling GPUs and investing in each other's stocks. This trend kind of resembles financial engineering and brings back memories of the late stages of the dot-com bubble. For example, Oracle's $300 billion cloud deal with OpenAI raised eyebrows, as it seemed to inflate valuations through cross-investments rather than deliver immediate economic benefits. Such transactions can distort market perceptions and potentially mask weaker than expected demand, increasing the risk of a market correction. Geopolitical tensions also pose significant risks. AI is no longer just an economic and technological issue. It has become a political one. Geopolitical risk can disrupt the AI supply chain, especially for chip makers. Taiwan's TSMC, which produces 80% of the advanced AI chips, is at the center of the US-China tensions, with export controls limiting China's access to cutting-edge semiconductors. Additionally, trade restrictions on NVIDIA prevent it from selling the most advanced products to China. Rare earth shortages, which are critical for chips production, can also become pawns in the potential trade disputes. Government regulations can be a double-edged sword. While government support plays a huge part in the AI development, poorly designed policies can hinder progress. Strict data regulations can limit AI companies' access to data, which is essential for developing sophisticated models. We see this with the European Union General Data Protection Regulations, or GDPR. Adding on that, energy restrictions due to environmental concerns such as limits on nuclear power for data centers could slow AI scalability, particularly for cloud providers like AWS, Azure, and Google Cloud. The AI ecosystem is huge, encompassing everything from chip foundries and data centers to foundational models and everyday apps. When you are investing in AI, it's important to recognize that fundamentals are just as important as innovation. While giants like OpenAI, Google, and Microsoft are battling for dominance, startups and service integrators have the potential to disrupt established value chains. This landscape presents both exciting opportunities and unique risks. Market leaders may have strong cash flows, but they also face fierce competition, regulatory pressures, and complex financial structures that can lead to volatility. To invest wisely, focus on clear framework that prioritize sustainable advantages and stay alert of hidden risks. The future of AI investing will belong to those who can navigate the complexity and anticipate disruption while separating the signals from the noise. Hopefully, with this guide, that person can be you. Our team of analysts work really hard on this, and it will definitely help if you leave some words of encouragement for us. If you'd also like to read the comprehensive article, check out the link in the description. As always, remember to hit the like button, subscribe to TradingKey, and stay tuned for more market insights. Thanks for watching, and we'll see you in the next one.